learning module. And not only because a decent amount of questions might be in your exam related to this learning module, but also because it's going to lay the foundations of your financial accounting knowledge, which will help you in all three levels of your CFA studies. So let's get into it and discuss all the things that we're going to cover. First of all, this learning module focuses on the income statement. In the previous learning module, we talked about the income statement, the balance sheet, the cash flow statement, the statement of changes in shareholders' equity. These are all the primary financial statements. And in this learning module, we're going to do a deep dive into the income statement. Now, you might remember from the previous learning modules video that we said the balance sheet is more of a snapshot at a given point in time, that what are the assets and liabilities and equity of a given company. Whereas your income statement is over a period of time. Let's say for the whole year, starting from January to December for a given year. So income statement is always for a period of time, and balance sheet is a snapshot at any given point in time. Cash flow statement is also similar to the income statement, that it is for a period of time, and so is your statement of changes in shareholders' equity. Now, what are the different names of balance sheet? We talked about it in the last learning module as well, and we will talk about it again in the future as well, is that this is the statement of financial position. This is another name for the balance sheet, statement of financial position. Why? Because this tells you what is the position of the company in terms of its assets, liabilities, and equity at any given point in time, a snapshot of the company's financial position. But your income statement is for a period of time, and it shows what has the company earned in terms of income, or in terms of earnings, or in terms of profit. So this has many names: statement of earnings, profit and loss statement, right? And of course, another very important name, statement of operations, that during that period of time, what was the company's operational performance? How much revenue did it generate? How much was its expense? What was the profit it generated? So essentially, what the basic equation of the income statement is: income minus expenses is equal to net income. There is, of course, a lot of expansion that will happen to this equation, such as, for example, we will say, okay, income plus gains. So you can break up your income into two things, which is income from your business operations, whatever sales you're having, or maybe there are some gains on your investments. Now that might be different than your income, because let's say my business is selling cars and I have a showroom in which I sell cars, but the price of my land on which my showroom has been built goes up. So that is a gain for me. And I let's say I'm moving showrooms, so I sell that higher priced land now, and I move to another location, but I record a gain on my property investment. Now, I'm not in the business of property. My income is coming from selling cars, but there is a possibility that I can have a gain, which is, of course, going to increase my net income overall, but it is not related to my core business. So this can be an expansion, or maybe there could be certain losses, right? Maybe there was a fire in my car showroom. Now that loss has nothing to do with my business. It is just something on the side. Now, why is this important to us as analysts? First of all, if you're analyzing a company to invest in its stock, naturally you are going to be interested in what is the profit of a company, right? Because what we want to see is how much cash it can generate for us, how much free cash it can generate. And that, of course, is going to be linked to how much profit it is having. So as equity analysts, we are interested in studying the profit of a company to be able to come up with a value for that company based on its profitability and based on its ability to generate free cash. As far as fixed income analysts are concerned, they are of course going to be giving a loan or a debt to a company, and they want to make sure that the company is going to be able to pay back this debt or service this debt, that is, pay the interest on time, and of course give the principal back as well. So as discussed, the components of an income statement are revenues, expenses, gains and losses, which is related to non-operating activities. So if there's money coming in from your related activities, from the normal course of business, that is going to be revenue, right? These are your core revenues. And costs that are related to your core business that are incurred to generate those revenues are treated as expenses. Now, if you're having some losses which are not related to your revenues directly, or if you're having some gains which are not related to your revenues directly, then they are separately mentioned as gains and losses. And of course, the end result is your net income, where you take your revenues, you minus your expenses, you add your gains, subtract your losses, and what you get is your net income. And this is what it looks like. This is a multi-step format. There is also a single step format, but the main one that you need to focus on is the multi-step format. And here, all the expenses or losses are having brackets around them, right? Because this is money going from the company. It is going away from the company. And all the positive ones are showing what's left. So let's go through it together, starting with the revenue of 2017, that this is the sales or the revenue from your core business. This company generated $31 billion, because this is in millions. So naturally this is going to be 31 billion. Actually, yeah, 31 billion. So this is a very, very large company. And what is cost of sales? Cost of sales is also called cost of goods sold. This is another name for cost of sales. Now, if you're a manufacturing company and let's say you're selling cars, right? So this sales would be from the revenue you generated from selling those cars, and the cost of sales would be the cost of making those cars, the product cost. This is also known as the product cost. And then you, after subtracting your product cost, cost of sales, or also known as cost of goods sold, right, you will get to your gross profit. Now, all of these other expenses that are mentioned over here are known as period costs. Period costs. Now, please see the difference between the two names. Product cost is what is the cost incurred to produce that product, which is why we call it cost of goods sold. If we are producing a service, then we are also calling it cost of sales. So a lot of companies just call it cost of sales because it covers both goods and services. So the cost to produce that product or the cost to produce that service is your cost of sales, which is your product cost. Now, all these other expenses, such as administrative expenses, whatever rent you are paying, whatever electricity bill you are paying, it's for that period from the start of the year till the end. So, since we're talking about 2017, let's say it will be from Jan to December 2017, and this is a certain period, and this administrative expense is for that period, the rental for that period, the electricity expense for that period, whatever you spent on advertisement for that period. And we are going to talk about depreciation in a little more detail, but all of these costs are for that period. Now you might be thinking that so the product cost is also for that period. Yes, correct. This is the cost of the product which was sold during this period. But it is possible that sometimes companies make products and they store them in their inventory. So let's say this particular given year, this company produced cost of goods manufactured, which is another term, worth 10 billion, but they are only showing 9 billion over here, is because not all of those products that were manufactured were sold. So only the products which are sold are shown, because the revenue is also the one which is products coming from the products which are sold. The inventory which is there, which has not been sold yet, is not showing in the sales, and it is also not showing in the cost. And this is very important because this concept is known as matching principle. Matching principle means we must show the sales and the cost in a matching way, where the sales of the products which are conducted in a given period should be shown in that period, and the matching expenses or the matching costs should be shown in that period, right? So here, with respect to the product cost, only those product costs are shown over here which are related to the products which are sold in this period. Any other products which are manufactured in this period will not be shown here. They will just be stored in inventory, and they will probably show up in the next year's cost of goods sold or the next year's cost of sales when they are sold. So this is a very interesting point, that when you are manufacturing something, or even if you have any other type of product cost, you are going to only show the product cost which is related to the sales of that period. However, when you talk about period costs, all of these will be shown in this period because they are related to this period. The rent that you have paid for this period is going to be shown completely in this period. The electricity bill which you have paid for this period is going to be completely shown in this period, and that is why these are known as period costs. Now I know I skipped this part in the middle, and let me just come back to it now and talk about this a little bit, that this is the gain that I was talking about. It could have very well been a loss as well, right? If there was an unrelated, and when I say unrelated, I mean unrelated to your core business. So any gain or loss which is unrelated to your core business is separately shown after your gross profit. And why that is because we want to have standards, financial reporting standards in place, which require companies to show their income statement, to show their financial statements in a way where the user of the financial statement, where the reader of the financial statement is easily able to see what is coming from core business and what is coming from maybe one-time activities, because core business is recurring, right? Core business is recurring. This profit from the sale of equipment, the gain from the sale of equipment is probably one time, and it's not going to happen again. So from the reader of the financial statements perspective, it should be very clear to see that what is recurring income and what is a one-time income. And that is why the gains and the losses have to be shown separately. So once we take the sales minus the cost of sales, we get the gross profit, which is your core business gross profit, recurring. Then you minus all your gains, add your gains, minus your losses, and minus your period cost, and then you come to operating income. Very, very important, because this, of course, is now showing the picture not only after subtracting product costs but also after subtracting period costs. So now you've taken your sales or your revenue. By the way, sales is also called revenue, so keep that in mind. So you've taken your revenue, you've subtracted your product costs, you've subtracted your period costs, and you've come to your operating income, which is also known as earning before interest and tax. Why is this so important? Because interest expense will depend on your capital structure. Now, what does that mean? Capital structure means how much of this business do you want to finance with your own money, which is equity, and how much of this business do you want to finance with debt, or which are loans. Now, the higher financing you get from debt, the higher the interest you will have to pay. If you're going to have 100% equity financing in this business, interest expense will be zero, right? So this depends on the owner. Before the interest expense is deducted, this is the core business. This is the, you can say, unaffected from the capital structure decision making process. Unaffected from capital structure. Now, capital structure is a decision that the management has taken. If the management changes, if you, let's say, are an analyst working for a private equity firm and you decide to buy this company out, maybe you can increase the level of debt or reduce the level of debt. But whatever is the current level of debt is something that is not important for you, because you are going to look at the profitability before the interest is deducted. That is why operating income is very important. And private equity analysts usually look at this instead of looking at the profit after subtracting the interest, which is your profit before tax. And naturally, tax is paid on the profit which is after subtracting the interest expense. So therefore, your capital structure decision will impact your tax as well. If you will have higher debt, you will have higher interest expense, and higher interest expense means the profit available for calculation of tax, which is the profit before tax or the earning before tax, is going to be lower, and therefore your tax expense will be lower. And finally, of course, is the profit after tax, also known as net income.